Well, hello everybody. This is Ken Himmler and welcome to another episode of the Wiser Money Show. Today is June 3rd, 2022 already. We're almost halfway through the year now, right? Almost. Well, I want to kind of give you an update to the broadcasts, and I'm going to be doing a lot of traveling here as we are acquiring more CPA offices across the country. We're going to be taking trips to make sure we visit those, and that obviously will consume quite a bit of time on a Friday because that's usually the best day to jump on a airplane, at least to get back to the family for the weekend. So we're going to do a little change up for a little while, and so starting on June 10th, the Wiser Money Show is going to change from content from the economic updates to learning and educational episodes. That way I can record these things while I'm in a hotel room or wherever I might be and then post them, and I can still keep you on the right track. But the whole research of what's happening day to day within the markets, well, a lot of that stuff, hopefully, if you've been watching me for any period of time, you know exactly what we're looking at. And we'll post every once in a while, once I get back, feet in the ground to less traveling. I'll post exactly where we are. So the updates will come less, but we'll backfill that with some educational content. And then part 3 of the special edition on how to protect, preserve, and grow your assets during turbulent times will be released for those of you as subscribers or on our email list. Okay, let's at least get into today's show. Unemployment. What am I talking about? Well, I'm talking about the unemployment. It's not really unemployment in as much as it is unemployment, meaning people really just don't want to go back to work. So I kind of made up that term. Hope everybody gets a little kick out of that. The new stimulus, Inflation, Stock Market, Secure Act, and the new econ map. Now, I want to let everybody know this is the first econ map I've changed actually since January of 2022. So I'll kind of catch you up to date with where some of our algorithms are going with that. So unemployment. Well, Biden is now offering free internet to everybody. Why? Well, he thinks, or the administration thinks, it should be 100% free, paid for by our tax dollars. The statement Biden made was high-speed internet is no longer a luxury but a necessity. I wonder if he knows that our country does have free libraries. So if a person, and our system actually has a bus system. So if you're that destitute, either the welfare system can provide a bus pass to you to get to the library. So I don't know if I agree with high-speed internet is no longer a luxury but a necessity. Anyway, unemployment, 11.7 million jobs openings right now and 6.5 million unemployed. Well, the Fed's answer, ask the larger companies to freeze hiring. I know. I know. You gotta read that again just to let it sink in, right? The government is now blaming large companies for increasing pay rates as the reason for inflation. It's interesting because the Fed chairman, or not Fed chairman, but the Treasury chairman, Yellen, came out and said, hey, I guess we did make a mistake. We did not anticipate inflation would go this high. Well, let's kind of add this up. If you give away free money and people don't have to go to work, the supply chain is going to choke, but people have money to go spend. The products are not there to actually supply the money that they have. And then the price will have to increase along with supply and demand. I thought that was economics 101, but I guess there's it's easy to be an armchair quarterback, or maybe not. The reason is if you give away free money, you take away the fight for someone to compete and strive to be better. We can look at hundreds of years of history of socialist countries, communist countries. Sooner or later, they falter. They fall apart because you take the fight out of the human, right? So inflation, well, last couple weeks ago, I had this slide up here, and I want to tell you what has changed just recently. I originally anticipated inflation would get under control by the end of the year. Well, wait until you see what I have on the new econ map. I anticipated inflation would come down 2 to 3% by the first quarter. Now I'm pushing that to the second to third quarter of next year because of some recent news, which I'll tell you about shortly. So now we're about 12 to 18 months away. And in this slide that I ran 3 weeks ago, I said, if this is going to happen, what you see above, we cannot have any more free money. will only extend inflation. So I did put that in there. This is the exact slide, but I'm crossing it out now because, well, unfortunately, there's now more free money coming in and it's going to flow into the economy. And I also stated that this was, again, 3 weeks ago, oil has to level out and oil production has to reignite, right? Well, instead of regenerating our national oil production and getting us oil independent, well, now everybody's going to get $400 that owns a car. Why? Well, this is, I guess, our government's opinion on how they solve the increased price at the gas pump. What do? They just give away more money. That's not the answer. The answer is you reignite the Keystone Pipeline. You put the people in the oil business back to work. You got 6 months until they're going to get their production back up and running. And in the meantime, you don't keep giving away free money because you're not going to have people go back to work. And then you're going to still have a supply chain choke. So the answer is not telling big companies to stop hiring. God, what a way to bury us even more. Okay, so I get a lot of questions about the Secure Act 2.0. So just to give you a little bit of history on the Secure Act, that passed in January of 2020, made a lot of changes. One of those, which was it pushed the required minimum distribution age from 70 and a half until age 72. It also eliminated the stretch IRA for non-spouse beneficiaries. Now, there's been a lot of controversy. If you've listened to me over the last couple of years, you know that the IRS has waffled back and forth. Originally, it said that the beneficiaries had to take money out of. So let me set a stage here. John Doe, right? He's got $1 million in his IRA, and he passes away, and he leaves that to his children. Under prior law, the kids could take that $1 million, and if there was 3 kids, they'd split it up. If they split it up equally, they could take it over their life expectancy. So, I mean, they might be in their 40s or 50s. They could spread it out over 30, 40 years. What does that spread out do? It reduces the tax consequence of that RMD because it's less taken out. Because remember, when you take money out of any kind of retirement plan, it's going to be taxed as ordinary income. Okay, so now what they did is they said, well, sorry, you got 10 years. You can't stretch it out for life expectancy. But there was no clarification. They said as long as you take it out by the end of 10 years. Well, the IRS agreed with that originally in 2020, but then in 2021, then they changed their tune on it. And then they said, well, you can't just wait until the 10th year to take it out. You got to take out, the kids have to take out RMDs. And it depends upon if the parents are old or older than the RMD age or not. Meaning, let's say that John Doe, who I used as the example, was age 75. He was already into his RMDs. Well, then the kids would have to take out the RMDs over the 10 years that they had to take everything out. At the minimum, they'd have to take out what the parent would have taken out. And then they have to dump it out, empty it out by the 10th year. Well, there was a lot of controversy on that because the IRS tried to sneak that in on Publication 590. And usually they open stuff up for discussion and comments by the professional communities, and they didn't. They just stuck it in there. And so there's a lot of yelling and stamping of feet. And so the IRS came back, and it was still in the middle of the pandemic, right? And they said, okay, what we'll do is we'll allow no RMDs if you die at this age, in this interim until the pandemic is claimed to be over. Well, that was kind of an open door to whatever they wanted to do, right? And so eventually what they ended up doing is saying, okay, now here's the new rule. If you died after December 31st, 2019, then you have to take the RMDs out every year, the child does, or grandchild, or basically non-spouse beneficiary. You have to take it out based upon if that person that died was over the RMD age or under. So if the person was under, you can use the child's age. If the person was over, you'd have to use the decedent's, the person that died's age. Okay, so now there's this Secure Act 2.0, which lays that out as law. That has a huge impact on retirement plans, especially large retirement plans. You got up into the millions of dollars, and boy, it's exactly what I've been talking about for 20, 30 years, is it's not always a good idea to defer a lot of money. All you're doing is you're deferring a tax bomb. You're creating this giant lump sum that the IRS can they can change rules and tax you however they want to tax you. So it's been my opinion that a lot of the fervor behind putting everything into 401ks and IRAs has been really the propaganda by the financial companies that want you to put as much as you can into those retirement plans because they run statistics, and the statistics are that you have less of a chance of taking money out of a retirement plan than you do of a non-retirement plan because you know of the tax consequences. So you'll leave your money in longer, then they can charge fees for longer. So right now where it stands is it sits within the Senate. And it has not been completely approved yet, but I would probably give this one about a 99.9% chance of going through. With what I read of what's going on with Congress, some of the conjecture or dialogue that's going on, there's not really too much argument about it. This will also increase the RMD to age 75. Now that's not going to happen overnight. Right now it's 72, and there's this small step in over a couple years, going all the way up to 2030, I think it is, and then you're over the age of 75. So it's a lot like Social Security. Based upon your age, there's a certain criteria. Now, what this will do is once this passes, and again, I'd be very surprised if it doesn't pass the Senate, it will accelerate the RMDs to non-spouse beneficiaries. So again, major tax problem on the horizon. So I want to cover something else here. Originally, when I put the Roaring Twenties playbook in, we were tracking that thing down to a T. I mean, it was literally a repeat of history, right? So if we look back at the 1919 to 1920 when we had the Roaring Twenties come in, it's because in 1917 to 1918, the Spanish flu pandemic hit the world, right? Virus hits the world. Well, back then they barely had microscopes that could really see much, and they really didn't know what it was, but they locked down, and they went through the same thing. Pandemic fatigue hits. Violence went up back then. And, people were just as angry as they are and were today during the pandemic. So there was a lot of accounts and news articles that I read that I was like, wow, this is just scary, about how angry people got. And it's cabin fever, right? Humans have to have a little bit of freedom, and they were literally locked down around the world. Same thing. So back in the 1919, 1920, this pushback hits, and people said, the heck with it. I don't care anymore. I'm not going to be locked in, and they just basically fought against it. But they had a couple years where they weren't spending any money, same as we went through, and all of a sudden, this massive spending spree happened. Now they went through a supply chain restriction too, because they still had a lot of people, and the supply chain was broken. But what the difference is now to then, and I'll tell you now, is right around January, January to March, we had around 5 trillion sitting in cash on the sidelines. And it was way above the highest recorded, which was in 2009 at 3.8 trillion in cash. But remember that the average cash on the sidelines is about 2.2 to 2.6 trillion dollars. So when you look at 5 trillion, you're like, hey, there's a lot of money still has to be spent, and the supply chain is still restricted. So once people get back to work and the supply chain opens up, that 5 trillion starts to get spent because people have this lockup mentality, right? I've been locked up, I just want to go have fun. But then in the 1919 to 1920 pandemic, the cash started to run out. It started to run out right around 2025, 2026, because people had this spending as a habit. You go on a vacation, you drive a certain car, you go out to certain meals. It becomes part of your habit. You don't look at it. It's human nature, right? You don't look at it as, well, that's just an extravagant expense. You start to assume it's an ongoing expense. So people then increased their debt back in the 1920s. And not only did they increase their debt, in order to keep up with their lifestyles, what did they do? They started investing in an unregulated market. It was completely unregulated. I mean, people could say anything about a stock in any public forum, and it wasn't illegal. They could pump up a stock that had zero earnings, lots of penny stocks, lots of stuff going on back then. And there was no SEC, there was no Registered Investment Advisor Acts in 1940. There was none of this insider trading rules. It was just the wild west. And so When the market crashed, it took them 15 years. So a lot of times people say, well, could our market take 15 years? Well, look, the NASDAQ did crash in 1999, and it took 15 years to recover, right? Because it was built upon just ridiculous valuations. I mean, if you remember back in 1999, when tech stuff was selling at 50 to 100 times price to earnings ratios, and the mentality on Wall Street was, oh, but PE ratios don't matter anymore. It's not relevant anymore because it's the tech world. It does matter because it will always come back to its mean. But that's what happened in 1999. There was a regulated market, but people were overpaying. Today, I still don't believe people are overpaying for the market. I do not believe that with the amount of cash that's still sitting on the sidelines. However, here's the biggest change today. In the 1919 to 1925, there was no free money. You had to work for the money. Remember, this is where Roosevelt came out with the Social Security plan and oh gosh, now I'm going to take a little mental break here. It was called the Great Plan or the New Plan. It escapes me right now, but it was the work plan. It's how our country built dams. It's how our country built roads. The government did the right thing back then. They created jobs. They said, listen, we know our country's in a tough time, and we're going to create jobs. We're going to create infrastructure. We're going to go ahead and do that. Well, if you look at the $1.9 trillion Build Back Better America program, and then you look at the CBO's real cost at about $4.2 to $4.5 trillion, which is the real cost, and you really look under the hood of that program, it doesn't open up jobs. It gives away free money. It basically incentivizes people to not work harder. Versus 1919 and 1925, it was like, listen, you want to eat, you want to have a roof over your head, you got to go to work. Now, remember, back in the 30s is when Social Security and that was created. In 1966, Medicare was created. So there was a lot of increases and improvements in that system, but there was no such thing as Social Security during that period of time. So you want to retire, you better have a good amount saved, or you better go to work, right? And so I do believe there's got to be a good balance. We have Social Security, we have SSDI, we have Medicare, which is the most unbelievable, greatest healthcare plan that I've ever seen because it's so affordable. Now, I think it knocks the socks off of doctors and puts them at a disadvantage. And I'm not going to get into hospitals because they're always making money. But the point is that the system today is so much better. We don't need to give away free money, because back then the reason that came out of the doldrums of that pandemic was you had to go to work, right? And right now we also have a weird system. It's not weird. It's a different. It's a dynamic that the cash is running down, but it's not due to spending. People are not buying more products and services, because more products and services would cause a healthier economy. What they're doing is they're buying the same number or a limited number of products and services, but they're paying the same thing. So we're seeing a cash drawdown of that 5 trillion that was sitting on the sidelines. We're seeing it draw down, but it's not improving the economy at all. So I'm going to jump over to the stock market, and then you're going to see how that all fits into the econ map. This basically is a 5-year chart of the S&P 500, and I'm highlighting here, if you look at the pandemic, and then you look at the high point, and that was at the end of December 13th, 2019, before the pandemic hit, and then the market drops 40-50%, well, or 35-40%, whichever index you want to use for it. And then what happens is it comes back in a big bang, right? Almost hits 4,800 or 600, somewhere around there. And then it pulls back a little bit. Why? Well, the Russian war, free money, which caused inflation, which caused a decrease in products and services flow and turnover. So, but you got to remember, look at where we were just simply 2 years ago and where we are right now. So again, it goes back to that emotion, that human emotion of saying, well, wait a minute, am I looking at where it was yesterday, and then if it went down, I'm getting depressed? No, we look at that second year, the bucket number 2 and the bucket number 3, and look, it's doing pretty darn well. So again, I'm only showing this not as a prediction, but just to say, listen, we're still ahead of where we were 24 months ago, and we've gone through some just horrible, horrible economic times. So let's just take an accounting of it's still okay, right? And now we're going to get into the econ map, and I've done some push forwards. All right, so let's show you what I've done. Back in 2020, I created this econ map, and this was when the election and the vaccine, phase one, moved into phase one was the shutdown, right? And then phase two was the election and the vaccine. Those were the two big ones in 2020. And I said in 2021, which was phase three, the growth depends upon vaccine and taxation. Well, they didn't pass the Tax Act and the Build Back Better America last year, which was a good thing in my opinion. Thank you, Mr. Manchin, because you knocked that out, so we didn't have to worry about it. So that's good. Coming into 2022, I originally had phase four back into 2022. I pushed it forward to the end of 2023 and into 2024. Why? Free money is not a good thing. And so originally, this is what you would have saw last week or 3 weeks ago on version 9.0. I had the stock market increasing to the first quarter of 2023, and I showed in the blue, you'll see that one dip. Let me see if I can highlight it for you. That dip was what I had originally put in based upon what I saw at that time in January. However, now I'm pushing that stock market back out to not recovering in July, August, but more in October, November. But again, there is another little issue here, and that is the midterm elections. That could change us into a version 9.2 with a change in that stock market. So the midterm elections are really going to make a difference as to taxes, rates, inflation, employment. However, we all know that the president gets executive orders and they can back channel certain grants. We saw what Obama did. He sidestepped the policy of forcing medical care on people by claiming it was a tax. So if you didn't have medical care, you could be taxed. And the government has the right to tax. They just don't have the right to force somebody to buy something. But they got away with it, right? Obamacare is here. So let's not forget that even with the midterm elections, it depends on the chess moves by the Democrats and by the Republicans as to who can get this economy into the right order of getting people back to work. So the midterm elections are not a make or break, but it does have an effect. Originally, I had productivity increasing because I made the presumption that there'd be no more free money given away and the employment increasing. However, I'm going to take a little dip on that because, again, every time they give away free money, it reduces the productivity because people have money to spend. Now, it's not as much this time as it was before with rent forbearance and mortgage forbearance and stimulus checks and all the other things that were going on. But it is still, you start giving away free money instead of fixing the root of the problem, you're still going to extend that issue. Now, originally I had inflation not increasing, but just, let me rephrase, increasing, but peaking out in mid of 2023. That was what was under version 9.0. Now I have it going up in the first quarter, which we saw, and I don't see that leveling out. I don't see that pulling back at the end of the year at all. I know a lot of predictions are it'll come back in October, November. I don't see that because of the free money and the extension of the lack of productivity. And real estate, we already started to see that. I don't have any changes on the real estate because I do believe that the Feds are going to continue to increase rates, not as aggressively as what I originally thought, but they'll increase rates, will push up the real estate prices. It will also disallow many people that would have gotten a mortgage to get a mortgage. The accounting right now is, as of this week, due to the inflation and the increase in interest rates, the average individual that wants to buy a house needs to earn $30,000 more per year than they did a year ago. While that is not good for people that want to become homeowners, it's really good for real estate prices, and it's really good to get that sector of our economy back in the right order because it was completely off kilter, right? So, what are the actions to take right now? Hold steady on stock investments. Please do not take an emotional move. Tax loss harvest with alternatives. We talked about that last week. And make sure your IRAs point to an IRA standalone trust. We know that this Secure Act is going to go through. So, the safest way to protect the taxation to the kids is making sure that it does not point to a beneficiary. Like, do not name your spouse as a beneficiary of an IRA or a retirement plan. If you're married, be very careful about naming your family trust as the beneficiary. If you're married, I would rather use an IRA standalone trust. If you're single, yeah, you can point your IRA or retirement plan to your family or to your revocable living trust. And I would hold on to any real estate purchases. I mean, if you have things you want to dump right now, probably a good time. Um, good. You probably heard this story from me last week. I had a friend that I've known for 35 years in Florida, and I happened to see him in the gym. Hadn't talked to him, and we just lost touch for probably good 10 plus years. And I said, "How you doing, Mike?" He says, "Well, great." He said, "Just sold my house for $1.2 million. It was worth $800,000 a year ago." And he says, "I already went through this debacle in Florida where I lost my house in 2008." He says, "I wasn't doing it again." I said, "I think that's a pretty smart move." He goes, "I'm just going to rent for a year or two." I said, "Very smart move. We've done the same." So again, hold on to real estate purchases if you're living in the house and you don't want to make that move. But if you've got rental properties, you've got other properties, and you say, "Hey, I want to liquidate, take some of my risk off the table," this is a good time to do it. And last two things, Roth conversions, do them right now. Market's still down about 10 to 12%. It's recovered from its 15 to 20% down, but you still got some opportunities to do it. And RMDs right now. All right, hey, before I wrap it up, Wiser Money channels on YouTube. If you have somebody that's in the accumulation mode, there's the place to direct them to. And if you are in the distribution mode, redirect them to the H&H Financial Center on YouTube. And with that in mind, give us a call. It's 844-702-1040. Hey, listen, have a great weekend. Ken Himmler signing off.